Good morning. You are watching a live market outlook for Thursday, 16th of February 2012. Negative sentiment in the markets persists as fears of possible complete failure of Greece's talks with the Eurozone and messy default. Increased pressure in the markets as Euro and Sterling are traveling lower. Euro hit its fresh 3-week low on the current bailout deal with the worries of possible complete failure of the agreement. Swiss franc tracks Euro down, hitting a fresh 3-week low versus the US dollar. Gold is again lower on the current fears, while dollar appreciates against Japanese yen in the recent rally, and also Swiss franc, as mentioned earlier. The stocks were also lower overnight as the sentiment remains negative. Greece, from the other side, seeks for a bailout to happen on Monday, as they expressed hope it can secure its second bailout in as many years, and the deal on easing its debt burden next week. But its Eurozone counterparts made clear the months of increasingly ill-tempered argument are not quite over yet. The Greek finance minister Venizelos said the Greek side had met the final two demands set by European Union and IMF to seal the 130 billion euro rescue, which Athens needs to avoid the possible chaotic default when big debt repayments fall due in March. But government official in Germany, which has not involved in testing exchanges with Athens over its will to tackle its problems, said the Greek side still had questions to answer. Greece pinned its hopes on a meeting of Eurozone finance ministers on coming Monday, after talks in Athens and at the Eurozone level failed to produce a deal to avert Greek bankruptcy, which could shake financial markets around the globe. The Prime Minister Finance Minister Venizelos told reporters yesterday the cabinet had decided how to plug 325 million euro gap in the 3.3 billion euros of extra budget savings this year, which the EU and IMF are demanding. And he noted that the leaders of both parties in the government of Prime Minister Papadimos had given written undertakings to implement the austerity measures, which provoked a night of fighting, arson and looting in the Athens on Sunday. Exasperated Eurozone finance ministers in the Eurogroup had demanded both steps to be taken before making a final decision in the bailout. So this is now the main question, whether the agreement will be reached or not, with additional pressure now on the increased fears of possible failure seen in the markets. We'll take a look into this in our technical part. Another things that keeps the sentiment negative is Moody's recent action that downgraded 6 European countries and also warned the big economies such as UK, France and Austria of possible losing AAA rating. However, yesterday, actually today, the Moody's warned it might cut the credit rating of 17 global and 114 European financial institutions in another sign the impact of the Eurozone government debt crisis is spreading throughout the global financial system. It was reviewing the long-term rating and standalone credit assessments of a range of banks, Moody's said, and markets were so far not heavily affected by this announcement. The Moody's said that among 17 banks and securities firms with global capital markets operations, it might cut the long-term credit rating for UBS, Credit Suisse, Morgan Stanley, as much as 3 notches following the review. It said the guidance was indicative. Among the banks that might be downgraded by 2 notches are Barclays, BNP Paribas, Credit Agricole, Deutsche Bank, HSBC, and Goldman Sachs. Bank of America and Nomura were included in those that might be downgraded by one notch. The U.S. rating agency said in a separate statement its action on 114 financial institutions from 16 European nations reflected the impact of the debt crisis and deteriorating creditworthiness of its governments. It cited more fragile funding conditions, increased regulatory burdens, and a tougher economic environment for its review of banks and securities firm with the global reach. Moody's salvo follows rounds of downgrades in European sovereign ratings as the Eurozone struggled to keep its weakest link, Greece, afloat, has been driving up borrowing costs and straining finances of other nations. As mentioned last Monday, Moody's cut the ratings of 6 European nations, including Italy, Spain, and Portugal, and warned it could strip France, Britain, and Austria of their top AAA level grade, leaving only Germany as the strongest economy of the Eurozone without any warning and with a positive outlook. From today's calendar, again, quite busy calendar for the day, the release of Far East countries will be just mentioned. The Australian unemployment rate dropped surprisingly to 5.1% compared to 5.3%. That was the consensus for today. And the previous month unemployment of 5.2%. Employment change in Australia shows a healthy gain of 46.3 thousand new jobs created compared to 10.5 thousand forecast for today. From the other economic indicators that are due to be released today, coming with Canada, with manufacturing sales due at 13:30 GMT, increase by 1% is forecasted for today compared to 2% of the previous month. From America, building permits monthly release due at the same time, 13:30, 0.68 million increase of the new permits is forecasted for today compared to 0.67 million of the previous month. U.S. weekly jobless claims at the same time expected to raise by 364,000 compared to 358,000 of the previous week release, while U.S. monthly PPI is expected to rise by 0.3% compared to minus 0.1 of the previous month. U.S. core PPI monthly is forecasted to go up by 0.1% compared to 0.3% of the previous month. At 1400 GMT, Fed Chief Bernanke is due to have a speech, while Philadelphia Fed Manufacturing Index is due at 1500 GMT, and the forecast better than previous release of 7.3 is 9 for today. Now we're going to take a look on the markets and see the latest movements in the main currencies and commodities. As we can see, the euro remains in the down move from its recent high, 133.20 that was hit on 9th of February, channeling steady lower as today's loss of our strong near-term support and higher platform at 130.25 now threatens of further extension lower. The negative near-term studies see potential of further losses for the pair, with the 50% Fibonacci test of the short-term up move from 126.22 to 133.20, focusing 130.00. Pardon, it was already taken out, 129.70, which 50% return, and the next static support at 129.30, low of 25th of January. On the upside, the immediate barriers come at 131 zone, also the 130.80 previous low, and 131 high of yesterday, would only break here to ease the current bear pressure and allow for a stronger correction higher. However, while the channel resistance at around 131.25 holds the upside, the focus is still on the downside with the channel support at 129.90 currently is coming under pressure as the pair already touched 129.92 low this morning. The wider picture for Euro sees it's weakening. The studies are pointing lower now as the pair loses momentum, and the break below 55 days moving average that held the downside in past a couple of weeks is now gone. So we see the potential of further extension lower, and the levels as mentioned before. Similar situation with the cable that is under pressure, and it's in downtrend of 159.26 high of 8th of February, where 200 days moving average limited the short-term uptrend from 152.33 low of 13th of January, with recent recovery attempt of 156.43 14th of February low being limited at 157.30 zone, previous low of 10th of February, also for our chart 20 days moving average that maintains the downtrend from 2nd of February. So in past 2.5 weeks the upside is limited, goes along with the channel resistance, the 20 days moving average, and the only break above these levels at 157.35, 157.70, which is the previous high of 14th of February, would ease the current bear pressure. Otherwise, the focus remains on the downside with loss of 156.43 to expose 156.00, which is a 55 days moving average on the daily chart, and the Fibonacci level at 155.80 that marks a 50% retracement of the entire move from 156.22 to 159.26. The dollar yen is in a steady uptrend with near-term price action being interrupted by brief consolidation that found good support at 78.20, previous strong resistance zone. The pair's clearance of very strong barriers at 78 at 78.27, 200 days moving average, and the main bear trend line drawn of 2007 high of 124.14. Now looks for a further extension higher as the pair gained strength again, and it's currently above the previous high at 78.65, looking for test of 79.00 and the 79.52. These are the two peaks of October 2011 post-intervention highs, when the pair rallied from its record low of 75.56 towards to hit fresh high at 79.52. Break above these levels is also significant. Will signal a break of the past 6 months range, basically from beginning of October, of August 2011. To break out of the current sideways movements as shown here on the weekly chart, and they confirm the bottoming at 75.56, 76.00 zone for possible further recovery. Immediate supports 78.00 and 78.20. 78.20 is the low of yesterday's intraday low. Then we have 17.13 for our chart to 20 days moving average, and also 78.27 previous high and the strong previous strong resistance, now offering initial support, while only loss of 78.00, 78.780 previous high would weaken the near-term structure and allow for a deeper reversal. For now, the pair remains in the steady up move and looking for test of initial barrier at 79.00. The dollar Swiss picks up recovery after a few unsuccessful attempts towards its short-term range ceiling at 92.50.60, as initially failed at 92. Then next failure was at 92.27. However, the dips were contained by 20 days moving average at 91.50 zone, with the latest rally breaking above 92.27, 92.50, 92.60. Currently testing 38.2 Fibonacci retracement of the recent down move from 95.93 down to 90.87. Would break here to open next immediately. It's 93.00 as round figure resistance, and more significant is 93.38 high of 25th of January. Also 38, also 50% Fibonacci retracement. Clearance of this barrier is to confirm the near-term base at 91 zone and allow for a stronger retracement of the short-term down move from 95.93. With next levels at 93.76 and Fibonacci 61.8% at 94 zone. On the downside, immediate support comes at 92.50, 92.50, 60 pips highs, ahead of 92.27, one of the other highs, and 92.00. 20 days moving average currently at 91.90, so loss of 92.00, 91.90 is would only weaken the near-term structure and keep the upside on hold for now. Otherwise, we see the steady rally and possible test of 93 and 93.38 in the near term. A brief look at commodities. Gold on the near term remains under pressure after a failure at 1737 yesterday, with fresh reversal lower and loss of 20 days moving average now threatening a test of initial support at 1710 zone. 1712 is the low of 14th of February, pardon. With area of supports at 1710, 1711, and 1704. Loss of 1700 support zone and the current range floor would further weaken the structure, as a wider picture outlook still shows the pair in the downtrend of the recent high at 17 of the record high of gold at 1920, as the yellow metal regained the initial barrier at 1763 but failed to break higher to test another significant resistance at 1800 zone. The wider picture outlook is still positive. However, studies started pointing lower, and immediate threat would be seen on loss of 1700 level. That would open initial dynamic support at 1686. That marks 90 days moving average ahead of 55 days at 1669, and the main one 1660, 200 days moving average. That would signal further extension of the downtrend from 1920. The crude oil is currently in the consolidative near-term mode after extending its recent gains of 95.43 low of 2nd of February, clearing all significant barriers, with the last one at 102.22, the previous double top of 18th and 19th of January, as it hit fresh high at 102.52 yesterday. Currently, the correction is underway, with the pair now dipping below the initial support at 101.20, coming towards 20 days moving average at 101.00. Next static support is at 100.28, and I would say only loss of 100 previous highs and the psychological support would weaken the near-term structure, as the channel support stands around here in this area. On the upside, the clearance of recent high at yesterday's high at 102.52 is to open the next strong barriers at 103 zone, and the more significant 103.72 high of 5th of January. Also, we have high of 17th of November 2011 at 103.35. So above 103, we have a strong resistance area, break of which is required to break the longer-term congestion between 97 and 103, and resume the longer-term recovery from 74.94 of low of October 2011, and possibly refocus its record high at 114.80 posted in 1st of May 2011. Good luck.